Welcome back, everyone, as we move into the afternoon sessions now. And I must say, it is great to hear the kind of chatter that has been happening out there and what this morning's sessions have already managed to trigger in terms of the conversation and the talking that is happening. So following on from that, we're going to continue now really immersing ourselves in very robust, frank, and honest conversation, right? I think that right at the top of the day, we had Valdine pretty much set that agenda, that is what we need to come out of the conversations we're hosting. And up for discussion in this session is going to be how policies and guidelines are driving sustainable development and finance before then moving into the next steps. Because let's face it, we've got public policy relating to finance having assumed the role of promoting a presence and activity of the private financial sector in green finance and overall sustainable development as well, ladies and gentlemen, in recent years. And it's as a result of that we've got climate change becoming a more prominent issue. And, of course, seeing us all gather in rooms like these for the conversations. That said, we are still looking at a significant financing gap, right, for sustainable development, anywhere between $2.5 and $4 trillion annually, and way off track when it comes to meeting the SDGs by 2030 as well. So lots more work needing to be done to close those gaps too. We're going to be taking a look now at what's being demanded of sustainability and climate investment policies to drive development finance, to better integrate ESG factors into the financial decisions that are being made, and shift investments towards climate-friendly and sustainable pathways. So for that discussion, please join me in welcoming to the stage now Tamsin Fremantle of Sandown Capital, and she's going to be moderating the session with an esteemed panel of guests. And Tamsin, I'm going to let you do the introductions there. Tamsin will also, in the final 10 minutes, be opening up for Q&A and for that conversation to make its way to you. So, Tamsin.
Thank you so much, Alicia, and thank you very much for all of you for coming to listen to us this afternoon. I started off with an esteemed panel, and very sadly, one person has left. So I now have a wonderful duo, the dynamic duo, who I'm going to ask to come up on stage. If I can first ask Dr. Luandle Mqadi to come up. Luandle is the sustainability expert from the IDC. It's called the ES, I think, you choose where you'd like to sit. Your title is ESRC, ESRG.
So we have included resilience.
And the R is for resilience.
Yes.
Okay, I'm going to be asking you about
Why?
that later.
Yes, I'll be happy to share that.
Welcome.
Thanks.
And if I could also ask Mr. Gili Dlamini, who is here from BASA. He has a number of portfolios in his purview, and sustainability is front and center of that. I have two economists on the stage, both agricultural economists, but two economists. So my challenge to both of you is that if I ask you a question, neither of you are allowed to say it depends. Okay, there will be a fines jar. There will be a fines jar for anybody who says it depends. Also, Gilly, no one-word answers.
Okay, all right.
All
good,
right.
Good.
So I would like us to have a discussion today. It is going to be a frank discussion, I hope. There's a lot that we need to be frank about. We live in a world that is increasingly unpredictable. I'm not sure that even death and taxes are predictable any longer. We also live in a world where the very concept of sustainability is taking a hit from some quarters. So how do we deal with that? I would like us to discuss the policy and the regulation side. I am going to sit down. I'd like us to discuss the policy and the regulation side. I want us to talk about what is being done, what needs to be done, and what needs to be done differently. As Alicia said, we've got years until we need to achieve those SDGs. 2030. Whew. It may have seemed a long time in 2015 when they were set, but it is right around the corner. And the issue has been that priorities have shifted, and things like COVID certainly set us back. The global geopolitical environment at the moment is setting us back again. But as Africans, we need to focus on the sustainability issue and how we're going to drive it forward. So, I want to start, and I will start, Luandle, by asking you. Tell me, is this whole sustainability financing issue as urgent as we're being told it is?
Yes.
Not a one-word answer.
I'll tell you why. It's because we're at crossroads, I think. And I'm coming from, those who don't know, I'm from the Industrial Development Corporation. And our mandate is to drive sustainable industrial development. And we've had that term, sustainable. And I think a few years ago, in the last 5 years, we've had to ask ourselves more now, what is sustainable industrial development? And that has taken us reviewing our strategy against our mandate and saying, are we still driving that mandate in the strategy and the investments that we're making in the South African economy? And at the core of that is sustainability. And how do we do that? How do we get to a point where we deploy certain funding or we deploy funds into the economy? And we're finding that for us to be able to do that, sustainable finance, it's what we are able to actually access, because we also raise our funding in the capital markets nationally and internationally. And most of that funding is coming in packaged as sustainable finance. So that's the first part. Mm-hmm. So sustainable finance is at the core of what we do. Then the follow-up discussion becomes, what is this sustainable finance? How do you define it in the context of your mandate as an industrial funder? And that's another discussion we've had to have internally. So you will have people saying, sustainable finance maybe is just there to assist us create jobs, nothing else. You can talk about climate, you can talk about all these wonderful things, low carbon. We just want to create jobs in this economy, and if we can have sustainable finance to do that, then let's leave it at that. Of course, it's not the end of our discussion. Didn't end there. We had to force ourselves to look beyond jobs, which is what has always been there, but we've started thinking in the last 5 to 10 years, because we're a long-term investor, about transformation of the economy from an industrial perspective. We've had to ask ourselves, when we do these investments in the economy, what kind of impact are we looking for? How do we define that impact? And that's why you've seen us managing certain funds on behalf of the government or the private sector. It's because they've come to us because they understand that we've looked beyond your normal jobs, transformation, or just climate. We look beyond that. So we've got what you call your social and solidarity funding, which is driving basically a lot of funding into your economy. And as part of that, we're even now looking at rural economy funds. We're looking at the township economy, and that's what sustainable finance. So for us, sustainable finance is broader than just focusing on climate, even though climate is still very important for us. So there's a big social component in our funding.
So what I'm hearing you say is the urgency of now is absolutely right, but we need to answer the problems that exist for the long term in order for the short term to work.
Yes.
Okay, thank you. Gilly, from your point of view, from BASA, the Bankers Association point of view, is it urgent?
Yeah, it's been urgent. You taught me to say just not yes. So
Thank you.
I'll borrow from the work that she has already tabled. She's spoken about many things I wanted to talk about, so that is covered. But I just want to take you back on the policy formulation or conceptualization for South African economy with regards to sustainability. I think I'm probably the closest, since you lost your first speaker, maybe I can cover that a bit.
Thank you.
Yeah. Now, if you look at climate finance, and then also you look at sustainability. The early discussions were more about mitigation. And when we figured that mitigation has got its own challenges in terms of measurability and also scalability, and then how practical it is for businesses, then we went to think about adaptation and also talking about creating resilience, which is required by business. Now, also, if you look at the government in terms of policy, they're a bit touchy in terms of prescribing policy. If you look at the sustainability policy in South Africa, in terms of legislation, there's not very many aspects that really are inspiring as the green people would love. You know, they find that there's nothing. Actually, they haven't. And the reasons are, when you talk about mitigation, you have to finance the initiatives, mitigations, and that is done through transition financing. And if you look at the South African economy, and it's a story everybody has heard, basically, that we're coming from an economy that is largely driven by coal, you know, and it's difficult to retrain or redirect those resources. There's a lot of livelihood that is carried by that sector. Now, government is really at crossroads. First, they don't have the money themselves, and they make a lot of money from coal. Yeah. So it's a conflict of interest. So that's what makes it difficult for them to be prescriptive when it comes to sustainability in terms of policy. And we've been engaging, especially the National Treasury in that space, the PA, that's the Prudential Authority in that space. It has been difficult to do that. So that's the policy environment. We've done very well with the Climate Change Act. We now they're doing well with the NDC in terms of setting up the sets, that is the sectoral emission targets. And after setting that, then we just say, oh my God, how are we going to finance this, you know? So they're looking at now, can we work on investment plans for the sets? So they're in the consultation stage as well for that. As we know, with investment plans, even for jets, we can only quantify them, and figures are different. But in terms of funding that, it's been difficult. That's when I'm not done, but I'm happy to stop.
So I just wanted to ask you, talking about setting policy, you're talking about the government's will in terms of policy prescription in this area. I know, Lwandle, you have something to say about this. Tell me what you think about the existing policy in this area for finance.
So it's been a very interesting development, and I was wondering if we could also have a discussion on how other countries have dealt with it. But let me focus on where we are as a country. So because of our mandate, again, we rely a lot on industrial policy. And if I were to ask any of you if you know of any industrial policy at the moment that we have as a country, and what is it called? I think I'm not going to get a straight answer around that. So as a country, we have not had a very clear industrial policy, even though we've had what we used to have IPEP, we used to have LEDs, and then lately we've been talking of master plans. Those are policy papers which have given us direction, and as the IDC, we've relied on those. We've developed some of those. We've made a lot of inputs into those master plans. So that's one part. And I guess it's also because, and I'm thinking out loud, it's because of the industries that have driven this economy. Do we really need, and the question should be, do we really need a set policy on how we're going to drive an automotive sector, considering the negotiations that we've had to actually have an automotive sector in this country? That will be just for one sector. The mining sector, one would say, at least have a mining industrial policy. I've heard people talking about that beyond other mining policies that we may have. But look at mining, which is the sector in which, which still drives this economy to a certain extent. How are you bringing industrial? Because we talk about beneficiation, we talk about all. How come you don't have a policy on that? And that's been a question which I don't think we've been able to answer as industrialists. And again, it talks to the nature of that industry, on how local yet global that industry is. So when it comes to industry and policy, I don't think from an industrial perspective we can have what the climate people have had, where, you can see progress from where they started and where they are. And I know your question would be, how are you integrating all of these climate change policies in the industrial space? He spoke about SET. And if you speak to a few guys in the steel sector, you've seen what's happening in the steel sector in South Africa. And the question is, do you really think the steel sector is thinking about SET?
Or just survival?
Or just survival.
Yeah.
Do you really, at least the automotive sector is thinking about new energy vehicles, but everyone is asking themselves, are we ready? Can we retrofit what we have for that?
So then my question would be, and Gilly, I'm going to come back to you on something now, but my question, Lwandle, would be, how do we translate the policy or the lack of it into practical application for raising sustainable finance? I know it's a $64 million question.
So we've been grappling with that at the IDC. We've got all these industries and they all need to be funded. And sustainable finance is the funding of the day. So how do you make sure that when you find the mining sector, they are thinking about sustainability or climate change at the center of that? If you are funding a manufacturing plant, how do you ensure that sustainability is at the core of that? So we've had to come up with various tools internally. And in the last few years, if you've seen what we've done, we used to have a responsible investment policy, which was hidden somewhere. But lately, we've had to think about what is responsible investing for us. Does it take into consideration all these climate change developments happening in the world? But also, which I'm not doing it justice, the just transition. So for us, it's a shift from just sustainability, ensuring that you align to the NDC and all of that. But for us in the sectors that we are operating within, the just transition is at the core of that. So how do you ensure that when a business partner approaches you, you are able to shape their thinking and say, I see that you want to produce bottles or bottle lids, but how do you ensure that your investments take into consideration the just transition in it? And a business partner will say, what do you mean? What is a just transition in my concepts? And that's the work that we've had to do internally, defining what the just transition is for the various industries that we operate within.
It sounds like you've been doing a lot of thinking at the IDC.
We have.
Good. Gilly, I want to ask you a question about our domestic capital markets, seeing as we're sitting at the JSE. Do you think we use them efficiently in this sustainability space?
Yeah,
and I'm not talking just about South Africa. I'm talking about the rest of the continent as well.
Yeah, let's start at home. When I look at that discussion as well, if you look at liquidity in the South African economy, it's quite good. You look at investment, and you measure that through the investment in the JSE. I think we're sitting at 100,300 right now, the index. And then if you look at the yield curves for the SA bond market, also we're doing great in that space. Now, if you look at the deposits as well in the banks, many banks have argued that they've got so much cash that is idling from individuals. They're not committing. So liquidity is not an issue in the market. But it's a question of where are they getting the best results? Best results is also mitigated risk. So the risk part, I think, has played a big role in actually stalling that decision. Now, going back to efficiency in utilization those funds, the sustainability financing side. One of the things, I mean, if you are pro sustainability, you want to think that people should rush and do that. But here's the thing: money is money, and it's got to be borrowed from the same capital, and it competes with other needs and other investments. It needs to show that it is doing at least par or even better than that. But it's not always the case, as some of you have also noticed. If you look at the green bonds and compare that with normal bonds, general bonds, the requirements on the sustainability bonds are quite reporting, the monitoring and the compliance. They require just more than what you would under the exactly. So, and also you don't get the funds cheaper, that you can pass even that kind of benefit to your business. That is the challenge. So to talk about efficiency is difficult to say that it is efficient. It is still nascent discussion or practice for many business, because they want to look at, if I do a sustainability initiative, I invest in that, will my bottom line actually get better, or at least not be affected negatively? That's the decision business is going through. It's not always the case. Sorry that I'm looking at you. You asked the question.
That's right.
Yeah. So sometimes it competes on it. You remember, I think Lwanda touched on a very key point, that business is about survival. You know, one of the things that business pursue is survival, sustainability in terms of finance. I'm not out of the market. I'm making good money. And then I can do compliance after that, you know. So compliance comes as a requirement. And if you have not so tight legislative landscape, then it really becomes debatable. That is usually the practice. So I don't know whether I've answered your question properly, but I'm just saying that I think we've got a lot of money, but it's not necessarily all of it, or the investment that we hope to see in sustainability.
Yeah, maybe I can also add to that, just to agree with you. And as a space, I think because we're DFI, we spend also a lot of time in the project development space. And before, it used to be a thing that you just do, but now it's become such an important thing. I know DBSA does that very effectively. They've invested at that a lot in project preparation. We also have an area in our organization focused on project development. We've had to actually think again and say, you know, project development is not a by the way. It's part and parcel of what we do. And because we're a long-term investor, we need to start thinking about how do we see this economy in 10, 20, 30 years. So a lot of our project development, or part of it, also goes into thinking about the future. And then also on the liquidity, we've just raised a sustainability linked bond and a social bond.
Yes.
Which was very interesting, because when we were going through the process of that, of pulling together the framework, the second opinion advisors kept on asking, so how are you going to do the monitoring? And we kept on saying to them, we've been accounting for jobs for the last 20, 30 years. So we're going to use the systems that we have, and they've worked. We're going to monitor them the way, we're going to monitor these investments the way we have. Tell us what you want us to change about them. Noting that we are going to incur all those costs. We don't want to pass these through to our business partners. So it's been a very interesting experience using the capital markets, which is very liquid, to try and access some of this funding, but for something very different, which is social bond or a sustainability linked bond. And within a sustainability linked bond, we started talking about the transition. Everyone is talking about the transition finance, but no one's talking about how globally the principles of defining what transition finance is not there. You know, globe as the world, we have not defined it. But South Africans know very clearly what transition finance. We want to transition
from where we are to...
We want to transition Fosco. We want to transition the whole of the Eastern Cape where cars are being manufactured, or the whole of Richards Bay. We're very clear on what transition is. And why is the world not understanding that that's what we mean by the transition? And the minute you add the just in it, it becomes another complicated
different conversation.
Yes, and I like that earlier on when the PMU and the PCC touched on this, that we now need to talk about transition finance in the context of our economy, and be able to tell the world that these are the principles guiding our transition. This is what the just is, and we're not talking about, grant funding here. We want the capital markets to be able to say this is how a just transition finance should be managed or monitored or even reported on.
So if we talk about the principles of transition finance, we're talking about guidelines. So you would be behind the statement that in order for anything to grow, in order for financing in this space to grow, we actually need those clear guidelines and policies.
Yeah, so that we're able to disperse it, because it's all sitting in people's, I nearly said, mattresses. Then I remembered I'm at the JSE, so
not in their mattresses.
Yes,
Okay.
yeah, yes.
So do you think that's why this this idea that we actually really need to be clear about our policies and guidelines is so important?
It's becoming more and more important, because we're no longer asking for grant. Yes, we still need grant funding to leverage certain forms of finance, or to put up the projects we have to a certain level. And of course there are transactions or business partners who will always need that grant funding just to get to a certain point. But if you really want to fund feasible transactions who want to participate in the economy, be in the manufacturing space, be in the textiles and all of that, those industries want to transition. They want to remain competitive. And they're want to be able to export into other countries. And when they start exporting to other countries, there are questions being asked. You're coming from South Africa with this product. Does it mean, what is the carbon intensity of this product? If you're not clear on those guidelines, then you're not able to compete at that level. But we're also saying, as part of that, for those people to be able to export, they need to be supported from transition finance, which has not been clearly defined.
So, Gilly, what do you think the role of the banks is here? From a policy advocacy point of view.
The banks are in a fortunate position to be able to dictate, diplomatically that is, to business what kind of initiatives they can finance.
Mm-hmm.
And also then you can influence the decision of the business. Because here's the thing, the sustainability must be actually experienced in the business. Banks are only financiers, we are facilitators of those business ideas. And when a business is set, the whole idea is to make money. Let's not play about that one. They want to make money.
There's no shame.
Yeah, that's why we're at JSE, fortunately. Now, if they don't make money by doing certain things, they will not engage. But Lwandle has introduced a very, very important perspective, the CBAM.
Yeah.
That plays a big role again, because if a client cannot sell produce or his or her product, then there's no sustainability.
That's the import rule into the EU.
Yeah. The EU and also the UK, I think, is more aggressive in that space. I think they're starting next year. Some sectors are being excluded. The steel sector is included in that, and I don't know how that is going to work for South Africa. But we have that role to facilitate, if you ask our role. But we can only do as much as the business can afford to take on debt, because we want that money back. Just as much as we put it in, We want to get that money back with interest. So if we determine that there is no affordability or the risk is too high, we will have a challenge with that.
Yeah.
So the banks have not actually compromised on that part. We will work with you so long as you can give us the commitment or you can convince us you'll pay us back. So if we cannot compromise, they also can't compromise unless the legislation forces them to do that. They'll find a way to do that. I'm not proposing that that happens, but I'm just saying that usually encourages people to really find ways to comply, that the business is legal.
I think we may have a comment on your left.
So what you're referring to is what we would call it the IDC economic resilience of all these struggling industries, and I'm sure you all have seen our results in the last 2 weeks, and
I wasn't going to raise this, but she volunteered it.
we can hide forever. You've seen our results, and it talks directly to what you've just raised. We always say it doesn't matter how great or not so great our results are, but they're a true reflection of the economy in which we're participating in. So if you get a chance to look at our results, you'll get a snapshot of where this economy is, what this economy is struggling with, on whether there's hope in this economy, or what can still be done in this economy. And we take you through our journey on very critical, on how we've performed in critical industries and sectors of this economy. But at the center of that, the question would be, are we still investing in business partners who can pay us back? Are we investing in business partners who are competitive, who are still going to be competitive in the next 5 years? So that's the story we tell. We're telling our investors and our shareholder, and we're hoping with that story there's going to be some change in terms of policy, and we haven't even started discussing the incentives and the subsidies, which I know people don't want to talk about. They're saying we are in this. We're having these challenges because of those things. We've never looked at, how we subsidize certain industries and how we provide incentives for certain industries. Maybe that's a problem. That's why we're where we are. So, but we have not discussed that. But what you're saying, truly 100% agree with you. But as a development finance institution, as a fund, and as a funder in the industries which are struggling, we're finding that we're experiencing that more than anyone else. I've tried to respond to that.
No, you've navigated quite well.
Thank you.
No, but it's sobering. It is a sobering reflection on where we find ourselves as an economy. And hopefully clarity on regulation and policy around sustainable financing may actually go some way towards helping that.
We need to do things differently. I mean, we're growing at what percentage,
Well, not
if
a
we
lot,
are growing,
I think is the answer.
Can I just come in here, seeing that Nolwandle is also coming in? She spoke about a very good tool that has worked quite well for developed countries in terms of incentives and subsidies. Can I just disappoint you today that our government is broke? So stop thinking about possibility of subsidies and incentive is not going to happen. Our borrowing capacity is at 76% of GDP, and that's max. Nobody can give us South Africa money anyway. So what South Africa needs to do is to look at how can we actually optimize what we already have in our budget. So we need to work, therefore, that like she's just spoken about economic realities and resilience. Let's start with those ones, the initiatives that are really impacting business in a profitable way, but also they have the sustainability impact.
Yeah.
If you can start with those ones and focus and exhaust that one, then we can try and risk a bit higher, than that. That's the reality that we have to deal with.
Thank you, Gilly. You both had quite an easy time with me. I think I'd like to ask if anybody in the audience has any questions, and I think we've got possibility of online as well. Is there a mic? I can see a hand up here.
Put your hand up again. Sorry.
Yes, this lady here, in the very pretty burgundy. Thank you, Thabo.
Good afternoon. I think I greeted the previous time. I'm from PRI. My name is Nozipo. I have a question, I think, for Lwandle. It's just one of the topics that have been surfacing when it comes to the economic transition. The youth especially is very concerned with the jobs, and even the mining industry or the minerals, they're very concerned with the jobs when we transition. Are you looking into numbers of the jobs that will be sustained when we are transitioning? For example, ESCOM, when we are transitioning from a high carbon emitting, way of working of business into a low carbon emitting jobs, or sort of. Are we looking into that? Can we put it into numbers? And I think you also had a question around how can we then mobilize capital to these projects or to these initiatives. Having a government or policy background, I think the best way we can do this, I agree with the guidelines, but strategy. When there is no strategy, we really cannot meet the deadlines. We have to have timelines. We have to have the cost of transitioning, the industries, how much. Try and be as specific as we can be, and I think we have expertise and capacity in South Africa to do that. Then probably we will reach our target for 2030, even not in 2030, but we could do very well by that time. So probably it's something we need to advocate strongly with government on, having a much more concise strategy. I've seen strategies work. I've done a few while I was in government, and I know very well that once we do that, then we can be a bit more concise and really reach our targets, rather than having these nice policy and these documents and plans that are not really concise and precise to what we need to do.
Have you got any comment?
I'll try. Yeah, I totally agree with you. Maybe also to just share. As the IDC off-balance sheet, we manage about 30 billion rands of funds in about 39 funds, which we define as funds in the social and the solidarity economy. And I'm not sure whether you're familiar with the Energy Resilience in Townships and Rural Areas Fund, the fund that we have. For example, last year the fund is about 200 million, and it looks at enterprises, and that's another thing that this economy has. And that's the space in which we're participating a lot at creating social enterprises and molding that space a lot, because we're finding that that's where we are able to easily disperse funds that is on the off-balance sheets. We were able to create about 754 women-owned businesses, which most of them were, half of them they could be classified as the youth. And we're able to, I think in the last year, we're able to create jobs for about 4,600 women just from that fund, and I'm not talking about other 39 funds. So there are pockets of, something is happening, but the scale is still important, and these numbers are very little. 200 million is not much. It's not much if you look at the challenges this economy is facing. But it's social enterprises, it's in the rural areas, it's in the township areas. That's where we are focusing with our off-balance sheet funding. And it ranges. I mean, we have another interesting fund that we're managing at the moment, is the Innovation Fund, where we're going to the townships and we we're introducing concepts of circular economy in townships. They will not be called, they don't look at it like that, but it's a waste management, project. But you're creating opportunities in the waste that you find in those in those areas. But we are not able to do that alone. We've got intermediaries who are assisting us to actually drive these concepts at that level, who are assisting us in creating these small enterprises which become programs, which become businesses that are able to sustain themselves. Yeah.
Thank you. Any other questions or comments from our audience? Yes.
Thank you. It's Karishma from Just Share. I have a question for the banking sector. You're keen, and we agree with you about the liquidity in capital markets, but what is more difficult to understand from your responses is why is the capital not being deployed and allocated? And what, from a banking sector and a private sector perspective, do you think are the biggest obstacles, and what would be the best mediation to kind of lift those obstacles from a private capital perspective?
Because you're not fair. Yeah, but I'm glad you asked the question, because I thought I touched on so clearly. I need to reiterate that the banks will access the funds when there's demand for it. So business needs to have the demand, the need for those funds, and also consider that those the sustainable finance capital is competing with already existing vanilla funding as well. So if the sustainability or the green finance preparation to access that fund takes 18 months, it makes it very, very difficult for banks to wait for that. I might as well use my own funds to finance. Just to give an example, I know one of the banks was trying to put together a bond with DBSA, and it took more than 12 months to actually access that fund, because the same reason, monitoring the prep, the project, DD, and all these, So we have a lot of in-house costs to actually access that fund. It is a problem. And then pricing for such funds as well is not necessarily preferential. And if it's going to come from MDBs, which are global, or Europe, it's even difficult, because there is this perception that Africa is very risky. And then they price it even higher. And it makes it difficult to really use that money. And then also the denomination usually is not ZAR. In many cases, it's going to be USD. And with the geopolitical issues, and even that we had exacerbated as is now, it just makes the cost of actually accessing and maintaining very, very difficult.
Which is why we need to make our domestic capital markets work more efficiently for us, presumably. Are there any other questions from the floor? One more at the back. I think this is the last one, I'm afraid.
Hello, my name is Robbie. Just picking up on this last question, and also going back to a comment where you said that the banks can dictate, and then you softened that a little bit.
Diplomatically.
In our experience, it's been exactly the opposite. Because in our experience, the biggest barrier to accessing green funds, and specifically for carbon in the carbon market, is that the credit committees in the banks do not understand the risk that's associated with green investments. And therefore, whatever you take to the credit committee does not make it through the credit committee. So I don't think it's the banks that dictate you shall go green or sustainable. I think it's the opposite. I think the demand for green finance, specifically for carbon finance, is there. It's massive. But they're running into a brick wall with respect to the ability of the credit committees to really understand the risks in the sustainability and in the green and in the carbon space.
I think we're saying the same.
I think, Gilly, you now have a new mandate to go and speak on behalf of BASA to the credit committees at the banks about the work they need to do to be able to understand not just the risk that Robbie says they don't understand, but the opportunity cost of not participating in that for the long run.
Robbie is so right in the latter part.
That excludes DFIs, though.
I know we time up, but it's a challenge that every bank is dealing with.
Yeah.
The structures that makes the decision, and Robbie chooses to differentiate the banks from the credit committee. It's the same thing, you know. It's the one is the one hand and the other hand, like the economist. So there is that disjuncture, and I think you're correct as well. We need to find a way to actually educate the credit people as well, because the officials that attend these sessions are usually your CSOs, that's your chief sustainability officers, anybody that does sustainability. But the deals has to happen through the normal credit committee.
Yeah.
So that's a very
So there's an
point.
opportunity.
Yeah, thanks, yeah.
All right, are we out of time? Okay, then I would just like to say thank you very much to both of you for your participation. I know it's been a short session. I would have liked it to have been twice as long. But I think what we can take away from this session is that policy and guidelines in this space, as in every space that is to do with finance, are vital for us to grow, A, what is available to finance, and B, what is available to finance with. But we need to do it as a real public-private partnership in order for it to work. Private knows what they need on the ground, and public can create the enabling environment. So thank you very much, Guga and Lwandle.
Thanks.
I really appreciate your time.
Almost hands for yourself.